but we're not ready to leave yet. But we'll be leaving in the near future. We'll be leaving in pretty much the very near future. But right now they've been decimated from every standpoint. And again, we've had great support from countries in the Middle East, great support, but we've had no support from, essentially, no support from NATO.
President Trump scolding European allies who rejected his calls for help in the Strait of Hormuz, even as he repels claims the conflict will soon end. Meanwhile, the near shutdown of the key shipping lane is wreaking havoc on energy markets, with the pain felt most acutely in Asia. Live from Singapore, this is Insight with Haslinda Amin. Asian stocks are higher while oil is a touch lower as investors look past Middle East jitters ahead of the Fed decision. Traders appear to be dialing back big bets against rate cuts. But gas shortages and surging fuel prices are putting India's growth outlook at risk. The fear of a prolonged Iran war is already forcing economists to cut projections and warn about inflation. Goldman Sachs economist Santanu Sengupta will explain why he's cautious on the Indian economy and whether the RBI could help. And Tencent set to report earnings today, with investors focused less on the bottom line and more on whether its push into agentic AI can become a real moneymaker. Our top story today, the U.S. president giving up on efforts to enlist partners to help end Iran's de facto shutdown of the Strait of Hormuz. Donald Trump scolded allies in Europe and Asia, even as he continues to insist the conflict is set to end soon. Meanwhile, Iran has confirmed the death of Ali Larijani, a veteran politician who helped lead Iran's wartime efforts against the U.S. and Israel, killed in an Israeli airstrike. Let's go to Dubai and bring in Horizon's Middle East and Africa anchor Jumana Basachi. Jumana, talk to us about what this all means for Iran's leadership.
Yeah, well, I mean, this is the most prominent assassination since the taking out of the supreme leader on day one of the military operations. It is another big blow for the Iranian regime. Ali Larijani was chief of the National Supreme Security Council. He was responsible for making many of those strategic and political decisions. He worked alongside the IRGC. He was actually a former commander of the IRGC as well, and reportedly had very close ties to the former supreme leader Khamenei. So this is just, effectively another taking out of a very senior figure that is entrenched in the power structure in Iran. But I will say, there are many circles also suggesting that because he was more on the political side of things, he was more involved in strategy, this removes one potential off-ramp or another contact that the U.S. could have spoken to directly should they wanted to go down the diplomatic route, because Larijani was actually involved in those nuclear discussions prior to the war kicking off. Unclear at this point who his replacement is going to be, but what we also understand is that another key figure taken out to the commander of the Basij paramilitary forces. Now, this is the group that has been responsible for the suppression of any opposition to the Islamic Republic. They would have been very involved in all of those crackdowns, the brutal crackdowns on demonstrators that we saw earlier on in the year and in prior episodes as well. So two very senior figures taken out, but at the same time, the military operations continue. Thousands of targets have been struck by the US and the Israeli military since the war has begun. We're day 19 now, with the US saying overnight that they have hit some deep buried missiles on the coast of the Strait. Clearly, one of the focuses of the Trump administration now is doing what they can to help ease the passage of vessels passing through the Strait of Hormuz.
There are some suggestions that the power will now lie with the IRGC. You got to wonder, does that change the path of the war?
Yeah, well, already we've heard from the current commander of the IRGC who's threatened to retaliate in a meaningful fashion It was a very heavy night, I would say, across the Gulf nations. We're hearing of another targeted strike on the U.S. embassy in Iraq. It's been targeted several times. More drones intercepted in Saudi Arabia. The pace, by the way, of interceptions in Saudi Arabia has started to pick up significantly. Over here in the UAE, again, as residents, we've received multiple missile alerts over the course of the evening, so more projectiles being intercepted. And then, as we were speaking about yesterday, they continue to go after key energy infrastructure sites. It was pretty notable yesterday that they targeted an upstream gas oil field in the UAE. That's the Shah gas field. They continue to try to target that key port on the Gulf of Oman, the Fujairah port. It is temporarily halted operations or operating in a limited capacity. And so I think the calculus still from Iran here is one that entails in inflicting as much damage as possible, economic damage on neighbors as possible, in order to bring about an end to the war, because the other side will deem that the costs have become so insurmountable that there's no other way than to pull back. But if you listen to the language that has come through, both from the Israeli side and from the US side, there's no indication that they want to let up. And if anything, what President Trump has indicated is that this war could still go on for several weeks, possibly even months.
Jumana, thank you. Horizon's Middle East and Africa anchor, Jumana Basechi, for us in Dubai. As U.S.-Israeli strikes on Iran continue and higher oil prices squeeze consumers, investors will watch for how the Fed weighs a range of risks to the economy. It's expected to keep rates steady tomorrow for a second straight meeting. Avril Hong is here with a preview. Avril.
Yeah, Has, the Fed expected to keep rates unchanged at this meeting and signal an extended pause. In fact, if you look at swaps pricing, you will see that December is when that one full cut for the year is fully priced in. And this is as a central bank, them responding to these higher oil prices. But flip the board as well, just to put things into further perspective for you. For U.S. consumers, you are seeing them being squeezed, as you highlighted earlier. Prices at the pump now above $5 a gallon for the first time since 2022. And it also speaks to, I guess, the pressures for the Fed on both sides of the mandate, because you'll have some people pointing to you how the February jobs report showed a softening and there are downside risks to employment. So those dual mandate pressures. For the board again, I thought amid all this, it was pretty interesting that our chief U.S. economist said that the Fed should maintain its easing bias, because with Brent between $80 to $100 a barrel, that could eventually dampen household spending and employment, which could eventually bring down core PCE. So that's something to keep in mind as well. It's set to be a lively debate regardless. And of course, we are going to be watching out for the updates to the summary of the economic projections, to hear on the forecast for inflation, unemployment, GDP as well, for clues on how Fed officials are viewing the longer-term risks to the U.S. economy amid this oil price shock. Has?
Avril, thank you. Let's get market insights with Aoifinn Devitt, Managing Director of Global Wealth of Moneta. Aoifinn, good to have you with us. Do you share the view that the Fed should be on an easing bias?
They should definitely maintain their course that they had already set. This is not the time for surprises. Markets are already beset with tremendous uncertainty. We know that 3 rate cuts had been priced in at one point. That may look unrealistic now, but what we are expecting is that they will at least telegraph that they are likely to stay the course. And I think taking the course similar to the Bank of Australia earlier in terms of raising rates would really send shockwaves into markets, and markets have very little capacity for more uncertainty at this point.
How are you assessing inflation risks right now?
Well, in terms of where we were before the outbreak of the current war, we were looking at inflation heading down, but still beset with some uncertainty. We know that labor was coming down and that services were coming down, but that there was still the element of surprise possible, and that we had seen this through just some surprises that had flared up in Europe and in certain around food inflation before the current outbreak. Now that this non-core aspect has ticked up, we know that this is likely to be, at least temporarily, inflationary. Whether that's enough for the Fed to change their policy, I doubt that. But we do expect that the consumer had very little leeway at this point to tolerate excess prices, particularly around fuel.
Talking about fuel, the oil shock is, I guess, has extended longer than most people anticipated as a result of the war in Iran. I'm just wondering, what do you do now? Some people are suggesting you should be sitting on more cash because there's a lack of clarity on where this war is headed.
Well, when we have a shock like we just had from the oil shock, we would expect to look for shock absorbers and for safety trades. None of the normal safety trades have actually worked well at this point. Gold, cash, there's government bonds. We haven't seen a particular tick up there in a flight to safety. So cash is still a good place to hang out, certainly, although with inflation, it is eroding daily. So not particularly safe in terms of preserving purchasing power. We would see energy stocks themselves as being a fairly good safety trade at this point, not just traditional fossil fuels, oil companies, but also because there's actually some uncertainty around the non-US ones there. But the green energy stocks have done well because we do know that the demand for electricity, for power, is insatiable, and that has well predated the current conflict.
Even as we talk about how gold is not a safety trade, it is having its best run since 1973. Why wouldn't you be buying gold from here, given all the uncertainties we're seeing?
I think we have to look at the performance of gold at the end of the year, end of last year, the beginning of this year. We spoke about last year being a defining year for precious metals. And certainly it was marked by very strong increase in the price there, but equally volatility really ticked up at the end of the year because who were the marginal buyers of gold at that point? It seemed to be central banks as well as Chinese retail investors. So that was causing tremendous volatility at the end of the year. So therefore, when we saw great interest in moving into retirement accounts being held in gold. And clearly there was a buyer that was not a typical gold buyer. For that reason, we were cautious about recommending gold at that point because of the potential for technical factors affecting the volatility. So certainly gold as a staple in a portfolio has some role for a small allocation, but as to be moving in tactically expecting it to act as insurance, we don't think it's likely to fulfill that insurance role, although we do see it being supported at these levels.
Interest rates seem to be reversing. We saw the RBI hike rates, which was a pretty much expected move. And we've heard from Bank Indonesia, it was a hawkish hold. And even the likes of the Philippines may raise rates in April when the central bank meets. I'm just wondering what opportunities you see given what we're expecting central banks to do.
Very interesting. I mean, this is what the pivotal week for rates with the 18 central banks, and some have already moved. Probably the worst possible week for central banks to be forced into action, given the cloud that is hanging over geopolitics currently and the lack of certainty. I think the interesting point is how much can central banks actually control with their monetary policy? When we have the supply-led shock like this is not really a lever that they have a lot of control over. Usually they would want to alleviate some of the stress with their rate policy and not add to it. So I think that will explain some of the reticence that we're likely to see from the Fed and may see from other central banks around raising rates. They really should stay the course. It's hard to believe, but this is still less than 3 weeks in this current geopolitical crisis, not enough to essentially divert a long telegraphed and well-planned policy. And that is where we are now. Central banks are telegraphing very well in advance what they're likely to do.
Thank you. Aoifinn Devitt of Moneta is sticking around, still ahead on Insight. AI is making the world unpredictable, and billionaire Howard Marks says that changes how investors should approach markets. His counterintuitive advice is next. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. Billionaire investor Howard Marks says traders are underestimating the impact of AI. Speaking to Bloomberg in New York, the Oaktree Capital co-founder told us investors may be better off buying AI-focused stocks rather than lending to the companies themselves.
I've been around long enough to have seen many cycles of boom-bust not economic boom bust of an idea. And, something new comes along. It's invariably something new because the new thing fires the imagination and is easily sold to people. And because it's new, there's never been a chance to see its flaws in action. So these things, I don't think there's ever been a bubble in something prosaic. There was never a steel bubble, or a hamburger bubble. But it's new technologies or new financial innovations. And so people buy in, on the basis of promise without an understanding of the downside. And then something happens which causes their expectations to be disappointed. And then they find out that they didn't know 100% of what they were doing, that they hadn't understood the limitations, and they end up unhappy.
How do you invest in a company that is tied to some of this new technology, given that it does have such promise, with any certainty? How do you select the companies that are going to benefit?
Well, first of all, many more companies will be affected than just the AI companies or just the technology companies. But, what I said in the December 9th memo, I touched on the wisdom of lending money for AI companies or tech companies to invest in AI. And basically, I quoted my colleague, Bob O'Leary, as saying that you probably shouldn't. If you're going to put money into a company exposed to AI, you should probably buy the stock and get the upside if it ensues, rather than just lend the money and get a fixed return if they're successful. And I think that's right.
And that was Oaktree Capital Management's Howard Marks speaking to Bloomberg. Aoifinn Devitt, Managing Director of Global Wealth at Moneta, is still with us. Even your take on what Howard Marks said. He talked about how, investors are pretty blinded by the risks in AI. Where then do you invest in AI?
Well, I always love to listen to Howard Marks, a great sage in markets if ever there was one. I'd say what investors, though, have been doing is they've been saying, I'll have one of everything, all of the above. I would like access to AI in the stocks themselves. And there's been the binge in terms of the Mag 7 stocks. And we know how much they now represent in terms of market cap. So investors are certainly not allergic to buying AI stocks. The issue is they want it in other aspects of their portfolio, too. And I've spoken before about the picks and shovels of AI, getting exposure to, say, the data centers. And this is exactly what investors have done through their private credit investments. We now know just how much was exposed to software as a service there. But that was also a play on AI, because we know that these companies were incorporating AI. They were not expecting to be replaced by it. I think that pace of change probably took everybody by surprise. But being in the private lending segment, which Howard Marks is referring to, that was seen as being a good hedge against some of this equity exposure. So I'd say, yes, all of the above. But the issue for now is we've just entered a new phase of uncertainty regarding winners and losers. We know there is more complexity entering the argument around governance and around societal implications, particularly around job losses. So that is why the AI story is getting muddied for investors just in the last few weeks.
And that takes us to the spat between the Department of War and Anthropic. How might this play out within the industry?
It seems like very old news now. It was only probably about 1 week ago that this broke out. I think this was seen for some as a signal, in that we know that Microsoft also was supportive of that. It was a signal for other CEOs to step up and to express their concerns and express the need for some guardrails. And then this all occurring when national security is of such a prime concern, probably again took the argument into a different sphere when it didn't focus on some of the principles. And the principles remain that we know now that, as I mentioned, governance is becoming a concern even for the creators of these tools. So there is, and we talked about OpenClaw in your previous segment, just how these really self-improving models are starting to work, these very automatic. And therefore, we know that there is simply a sense of this is really getting unleashed. So that argument that will enter the equation. Of course, how will this represent itself in stock prices? I don't think this will really have a big impact on share prices. We know that the demand for Claude soared in the aftermath of it being declared a supply chain risk. So consumers vote with their feet very much when it comes to AI. What it is, though, is bringing the argument to a new level, which is important because we do need to think about societal implications, because that is what drives the K-shaped economy we're in and what will dictate the health of the consumer and their ability to find a job.
Even you talked about open claw, companies like Tencent, Alibaba in China capitalizing on that. Are there opportunities in this part of the world, in China in particular?
I think there are massive opportunities, and that is one that is probably not very well known outside of the region. What we know that going back in terms of DeepSeek, just how much competence and how much ability to steal a march on the progress of some of the US-based AI companies that there is outside the US. I think there is less appreciation of that by investors, although investors, certainly with the rise we saw in Chinese and Taiwanese stocks in the beginning of the year, they were starting to get wind that these stock markets could be a very big play on tech that would really bolster the existing tech holdings. So there is tremendous opportunity. And that's a little bit of the reason why there was so much concern about putting any guardrails around US tech companies, suggesting, well, there are no guardrails outside the US. So why would we tie one hand behind our back, essentially?
As much as we talk about the opportunities in markets like China, there's also increasing scrutiny. Open Claw was case in point. It had a very, big support, yet, the government wasn't too keen on it because of concerns. So how do you balance the interests, the opportunities with the scrutiny that you see in a market like China?
Well, it's very, to see the scrutiny in China, which is very much at the forefront of the development, is again very healthy, because we are essentially building this bridge as we cross over it. So there is a need not to be just blindly following the technology and not looking at the implications, not only for security, but for some of the human guardrails that we've put in place. So I'd say that is very much, but what is happening very quickly is that the guardrails and the regulation are also being developed quickly. So that is a sign of an adaptive regulatory system that is exactly what is needed. It is essentially the old regulatory system needed to be rebooted to take into account of the business models that are changing weekly. And I'm very encouraged to see that that's in place.
And that's just it. Changes are coming weekly, if not daily. In fact, I'm just wondering your assessment of the risks out there, which may be underappreciated by the investment community.
Sure that they're being underappreciated. I think if we look at the rotations that we've seen since the beginning of the year, we've seen very clear rotations out of growth into value, out of the US into non-US, out of large cap into mid and small cap. So these, and then out of the tech sector into the other sectors. So this has been part of the rise behind the energy sector. It hasn't just been the outbreak of the conflict. It was very much predated that. So these rotations indicate that investors are taking profit, are cautious about concentration, are looking to build a balance and a core and complexion to their portfolio. So I'm not sure they're underestimating it.
Welcome back. You're watching Insight, and here's a quick look at where markets stand as mainland Chinese markets head to lunch and Japan comes back online. Asian stocks extending gains for a third day. The MSCI Asia Pac Index now up about 1.5%. Investors looking past geopolitical tensions. Of course, oil dropping, but still above that $100 level. We're also keeping an eye on Indian assets ahead of the stock market open in about 15 minutes from here. Global investors extended their selling streak on Monday, offloading Indian equities for the 12th consecutive session. The latest data showed that foreign funds dumped more than $1 billion worth of Indian stock. Nifty futures currently up about 0.5%. Now, Nifty has fallen more than 10% from a peak back in January on the back of the energy crunch and surging oil prices, which some say will impact India's growth. Of course, global funds have been extending the selling on the Indian benchmarks. Meantime, India's growth prospects in limbo as surging oil prices and gas shortages prompt analysts to cut forecasts and warn of rising inflation. The nation remains highly dependent on the Middle East for its energy needs, with 90% of its crude and nearly half of its LPG coming from the region. But as investors price in the economic impact, Indian equities are approaching a level that historically precedes a rebound. Let's get analysis from economy reporter Shruti Srivastava joining us from New Delhi. Also with us from Mumbai is equities reporter Ashutosh Joshi. Shruti, let's start with you. How is the West Asian crisis impacting India?
So absolutely, let's keep in mind that India is one of the major economies which is most exposed to the crisis that's going on in West Asia right now. That is simply because India imports 90% of its crude oil for consumption and nearly half of the liquefied petroleum gas for its consumption, and most of which passes through Strait of Hormuz, which is all but shut right now. This has, this of course has led to soaring oil prices and acute shortage of LPG for Indian households, hotels, restaurants, industry. The government has rolled out measures to curb industrial use of LPG, and that has already started showing impact in many sectors, including engineering, ceramics and glass, petrochemicals, plastic. We have been told by exporters and manufacturing units that they have virtually shut some of their units because of shortage of LPG. This is also impacting, gig economy, most of whom were reliant on hotels and restaurants for the deliveries. Given the petrol prices, given the surging oil prices, they are worried and concerned that this entire episode and crisis will impact their earnings. This is also, of course, likely to have an impact on the external sector in India. Exporters who export to the Gulf region, they have already started saying that, the March is going to be very bad for them, which is going to have an impact, of course, on the rupee and the trade deficit and the current account deficit. Rupee is already under pressure, and this is going to add further pressure on that.
And of course, that's weighing on investor sentiment in India. Ashutosh, we know that Indian stocks have been trying to find a floor. Are they close to that? Might a rebound be coming soon?
Absolutely. While relentless sell-off in India continues, it's been almost a year where Indian shares have been sort of lean patch. The sell-off expedited in recent months following the AI-related worries, and now the war in the Middle East is impacting the sentiment. However, with this long period of weakness, there are certain technical indicators that traders are drawing comfort from. A couple of ratios are indicating that the market is set for a short-term rebound. To be sure, the expectation is not for a turnaround here. A number of indicators are pointing that the downside for market from here is very limited, and that is leading to some comfort for investors. And as we are seeing, last two sessions, Indian stocks recovered, and start of this session also points at a positive mood in the market.
Well, as you said earlier, India imports almost all of its oil needs, and currently oil is hovering at more than $100 a barrel. Surely that will impact sentiment going forward.
Absolutely. Oil remains the most important factor here. A number of factories have announced halting their production. What this means is that the month of March, there will be impact on their performance. And if this situation continues, which is now appearing to be is now appearing to be a possibility, this impact will further stretch into the next quarter. Put together, this impacts the outlook for earnings. Some of estimates are signaling that if oil prices remain at current levels, we are set for a 10 to 15% impact on EPS growth estimates for fiscal year 2027.
And Shruti, $100 oil is bad news for growth, bad news for inflation.
Definitely. So, let's remember that, India actually was in a very sweet spot. Just a month back, the RBI governor, he had called this the Goldilocks scenario for Indian economy. The government expected the growth to be as much as 7.2% in the next financial year, which starts April. However, that situation seems to have changed now with soaring oil prices. Economists across banks, including Goldman, they have cut their growth forecast for the next financial year, anywhere between 0.5 percentage point to 30 basis points. And many economists are saying that this is also going to impact inflation. One of the economic estimates shows that inflation, which was expected to remain near RBI's targeted range of 4%, is likely to go as high as 6% by end of September or October. So definitely an impact on the industrial production because of the shortages. That is going to have a definite impact on growth.
Our economy, trade and investigating agencies reporter Shruti Srivastava and our Asia equities reporter Ashutosh Joshi there for us. Well, our next guest now expects India's economy to grow at 6.5% this year, down from an earlier forecast of 7%, and that's due to the crisis in the Middle East. Let's get more from Santanu Sengupta, Chief India Economist at Goldman Sachs. Santanu, that's quite a shift downwards. What's prompting that move? Is it basically oil?
Yeah, thanks for having me. Yes, it is mainly oil, but if you look at the terms of trade shock that India is facing, it is slightly different from the earlier ones, because at times when oil prices rise, yes, India's import bill rises, but the Middle East, which is the main producer of oil, typically does better. This time around, that region is impacted by the conflict. And India is quite integrated with the region compared to 10 or 15 years back. Almost 13% of our exports go to the Middle East. It nearly is about 80% of gas imports, 40% of crude oil, and 40% of remittances. So if that gets impacted, the terms of trade shock just gets bigger. The second thing to note is that there is, as your team pointed out, there's a shortage. So there is some prioritization or rationing of demand that is happening given the gas shortages. So the government at this point of time, rightly in our view, is prioritizing household cooking gas, which means that this is getting prioritized over industrial usage. So undoubtedly, there'll be some impact to industrial activity, which is why we have taken the numbers down 50 basis points to 6.5% for calendar 26.
Would you have to review 6.5% further if oil remains above $100? What are your own assumptions? What scenarios are you planning out if oil is at 100, 110, 150 even?
Right. So the underlying assumption is our commodities team is forecasting with a baseline assumption of 21 days closure of the Strait of Hormuz at around 10% of capacity flowing through the strait, and thereafter a gradual reopening over a month or so, which takes the oil numbers towards 85 in April and thereafter lower into the 70s by the end of the year. With those underlying assumptions, and very importantly, the assumption of fiscal policy doing the heavy lifting in terms of protecting the consumer, which means that we are assuming no pass-through into fertilizer prices and the government completely stepping in to take the fertilizer subsidy on their own books, worth about 0.3% of GDP at this point of time, in our view, that gives you the forecast of 6.5%. Now, if the assumption is that oil prices are either higher or the fiscal support is not as much as what we are anticipating, we think there will be a bigger hit to growth. Another important thing to remember is that India has a quasi-fiscal absorber through the oil OMCs, the energy SOEs, where petrol and diesel prices are kept or are being kept unchanged at the pump price, at the pump level. And our assumption is that remains that way for the foreseeable future, and therefore you have no pass-through to the domestic consumer at the moment.
Santanu, fundamentally, how resilient is India's economy? It did recover really quickly from COVID, from the pandemic. Might it be able to do the same this time round?
Yeah, the fundamentals are the starting point is fairly good. I mean, before the oil shock hit us, we were pretty constructive on the economy. We were thinking it's a cyclical rebound. fiscal policy tightening had done its work already in the previous 3 years. The tightening this time round was very small, only 10 basis points of GDP. Monetary policy had eased 125 basis points along with liquidity and deregulation measures in the previous year. All of that was feeding through the system. Credit growth was rising towards 14% consistently for 2 months. During that period, this shock has hit us. The other important change which has happened for the Indian economy over the last 5 or 7 years or so is the strength of the balance sheets. The corporate sector balance sheet is healthy. It's deleveraged. The bank balance sheets are healthy. The external balances, while there's a widening of the current account deficit, undoubtedly, the external balances are fairly healthy. The external debt to GDP is low. Foreign exchange reserves are north of $700 billion. So in terms of the ability to handle the shock, we think that the structure of the economy or the balance sheets are in a fairly good position.
So would that give the RBI confidence that everything will work out? When you take a look at the other central banks, they are considering tightening. We saw RBA tighten, and Philippines, Thailand may do the same if that is what's needed. What might be playing out in terms of the RBI's thinking?
Again, if you think about the assumption of fiscal policy doing bulk of the heavy lifting in the initial period for the pass-throughs not to happen from higher oil prices or gas prices onto the consumer, with that assumption, we think that the RBI stays on hold and keeps liquidity adequate enough for the overnight rate to hug the policy repo rate. We just think that the growth downside is coming along with the inflation upside, but your starting point of inflation is quite low. I mean, you averaged somewhere in the region of 2.5% inflation last year. In our view, you'll go in the fiscal year towards 4.5% odd. And therefore, the RBI has some time to assess what to do and doesn't need to react in a hurry to hike rates at the moment. The INR, we think, remains under pressure. Sorry, go ahead.
Yeah, I was just going to say exactly that. What would prompt the RBI to tighten? Would it be the Indian rupee?
With the rupee, the INR remains under pressure in our view, given the fact that your current account deficit is widening. We think this will be a consecutive year of balance of payment deficit. And therefore, the obvious thing would be the INR to weaken, we think, 95 over a 12-month period. In our view, the RBI needs to tighten if there are pass-throughs that happen to the domestic consumer. It is too early to judge that, A, because of the level of oil prices, B, to understand how much quasi-fiscal and fiscal can take the hit before it needs to pass on to the consumer. I think that question will come up more a quarter or two down the line rather than now. So our view is that for now, the RBI remains on hold at 5-quarter repo rate.
Consumption, of course, is very key to the Indian economy. Are you seeing any weakening at all? And what are the signs that you'll be looking out for?
We were actually seeing a recovery in the rural consumer. We were quite optimistic about the mass consumer recovery, A, because the food cycle was fairly good, B, because you've had some transfer payments happen at the subnational or the state level, worth almost 0.8% of GDP now, multiple state elections coming up, and so forth. Part of that gets dented with the oil shock, but again, remember the implicit assumption that we are making is that fertilizer prices, where natural gas is about 75% of the feedstock, gets absorbed on the fiscal balance sheet. So we do not think that passes on to food prices, and therefore we are still fairly optimistic about the rural economy to handle the stress. In terms of the urban consumption, look, there are more question marks. A, the cyclical hit that you're getting due to the terms of trade shock. B, what is happening to overall jobs and so forth. So I would say that the rural is where we are more confident about the recovery sustaining than the upper end urban.
How about elsewhere? You talk about the oil shock. You got to wonder how long the government can continue to absorb that oil shock before that gets translated to higher prices at the pump.
Right. With the oil shock, again, as I said, our implicit assumption is about 0.3% of GDP gets absorbed on the fiscal balance sheet with the fertilizer prices. So this is completely the assumption on gas and fertilizer prices. The pump prices of petrol and diesel, which gets absorbed in our view by the quasi-fiscal for now, is completely on the OMCs. There will come a point of time if oil prices remain elevated. So if you're thinking about a $100 oil price for a quarter or more, at that point of time, maybe the time will come to think about excise duty cuts to pass on to the OMCs to absorb this shock, such that the pump prices remain unchanged. If the time really comes that the fiscal gets much wider than what we are anticipating at the moment, that's when we would be thinking about passing it on to the consumer. But again, our first port of call is the fiscal and the quasi-fiscal absorbs the shock.
We know that the Iran war impacts India two ways. One is higher oil prices, and the other is, of course, remittances. 10 million Indians work in the Gulf region. How much risk is there to the economy if there is a shock from remittances from the region to India?
Yeah, it's $135 billion of net remittances last year. The last number that we know is that about 40% of that was coming from the Middle East. This number used to be much higher, north of 50% earlier. It has come down to about 40%. So undoubtedly, if the region is impacted, which was my starting point, that the shock is different this time than a normal energy price shock. Because during an energy price shock, otherwise, the Middle East, which is a producer, does better. Their economy does better, and therefore you have higher exports to the region and higher remittances from the region. And this time around, that's not going to work out. And therefore, we think that the external balances hit is bigger. We are thinking about a 3 times current account deficit from about $15 billion. We think that this goes towards 0.4% of GDP in calendar 25. This scores 1.2% of GDP or beyond this year.
And Santanu, when we talk about supply chain disruptions, it's not just about oil, it's also about petrochemicals, it's about fertilizers, which is really critical for India. How concerned are you about a potential fertilizer crisis impacting India?
Right. Again, if you look at the 2022 cycle, when fertilizer prices got impacted, the government again jumped in. Fertilizer subsidies went up by about 0.5% of GDP compared to the budget estimates. And implicitly, the assumption that we are making this time is around 0.3% of GDP gets absorbed on the fertilizer subsidies account. India imports about 50% of its natural gas requirement. About 80% of that comes from the Middle East, mainly Qatar. And therefore, at this point of time, India would be looking at alternative sources of imports of gas, US, Australia, and so forth. The fertilizer sector imports around 85% of its requirement. And therefore, it is a critical sector. The government, in our view, will do all it takes to really protect that sector from pass-throughs into food inflation, because that is when the question of the RBI coming in and tightening rates and so forth will come up.
So all things considered, do you see a need for more borrowings by the government?
Yes, it's an interesting question. I think it's very early to judge where the fiscal position will be, because the next fiscal year hasn't even started yet. Look, our view is that there will be some higher dividends from the RBI, and we'll have to see along the course of the year where the fiscal deficit actually ends up. Our sense is that there is a risk of higher supply going into next year, given the duration of this shock, and that is the real uncertainty here. In terms of prices, about $100 or $110 odd is where you've seen prices peaking. Duration is longer, then there's a risk of higher supply and some steepening of the curve. Our view still is that the RBI comes in, does OMOs to keep long-end yields capped, but also to infuse liquidity such that the overnight rates are around or hugging the repo rate, and there's no financial conditions tightening.
Santanu, great perspective there. Thank you. Santanu Sengupta, Chief India Economist at Goldman Sachs. Still to come on Inside, Nvidia's CEO Jensen Huang says the company is restarting H200 production for China after securing U.S. licenses. Keep it here with us. Welcome back. You're watching Insight. Nvidia is firing up production of H200 AI accelerators for China. CEO Jensen Huang says the company has secured licenses for many customers and is restarting manufacturing for a market once blocked by U.S. export restrictions. Bloomberg Tech co-anchor Ed Ludlow reports from the chipmakers' annual conference in San Jose.
The situation for Nvidia has changed in China literally in the last 3 weeks. It seems like now there are multiple licenses for customers in China, and Nvidia is taking steps to meet that demand. Here's what Jensen Huang had to say.
We've been licensed for many customers in China for H200. We have received purchase orders from many customers, and we're in the process of restarting our manufacturing.
The biggest piece of clarity came around that $1 trillion figure, a sales opportunity 2025 to 2027. It is just Blackwell and Rubin-based systems. It does not take into account any revenues or revenue opportunities from CPU or even Grok, although Jensen Huang did say that if you factored Grok into it, there could be up to 25% upside on that $1 trillion figure. Beyond that, it was very much a kind of state of the world. It always is at GTC, where Jensen Huang holds court with the press and goes through a wide range of issues. But probably the biggest thing beyond sort of talking about how robust demand is the solidity of supply chains. There's going to need to be trillions of dollars worth of capacity put in place to meet the supply that's required for current demand. Jensen Huang also addressed what's happening both in the Middle East and in Iran. Nvidia has lots of employees in Israel, and he said that the company is committed to Israel. He's very worried about his employees there. And as it relates to Taiwan and the future of Taiwan, Nvidia is 100% committed, and its supply chain has heavy concentration there. That is not going to change. Ed Ludlow for Bloomberg News in San Jose, California.
Still ahead, Asian stock investors juggling headwinds from the Iran war and AI fears. More to come. This is Bloomberg. Welcome back. You're watching Insight. Here's a quick check on the markets. Asian equities are edging higher as oil declines, suggesting investors are trying to look past uncertainty sparked by the Iran war and find a measure of stability. But Bloomberg MLive executive editor Mark Cudmore says a misplaced perception of equity resilience is fueling broader investor complacency. Mark joins us more. It's true, I've been talking about this, how markets are underpricing risk, but they keep saying when you take a look at the outlook for earnings, everything remains intact. Lots of, fundamentals still intact for this rally to continue.
I think that the market is pricing in more pain than people realize because they're looking at US stocks. So I haven't checked today. I will admit this is a bit embarrassing, but as of yesterday, the MSCI All Country World Index was having its worst month in 3.5 years. So its worst month since its last bear market for global stock market index. So I think, markets are falling rapidly. In fact, if you annualize the pace of decline from March until Monday's close, it was 63% annual decline, which would be obviously cataclysmic for stock markets. I think the reason that people think there's not much pain is because US stock markets aren't weakening much. And I think there's a couple of factors to that. One is that the narrative going into the conflict was the idea that US stocks would underperform. So that's where people were underweight relative to benchmarks. People aren't short the US stocks necessarily, but underweight there. And you can say particularly that one of the indexes one of the sectors that's done best this month is software, which was suffering because of the SaaS apocalypse for the previous few months. So it fell 27% into March and is now up a few percent in March. And it's basically people just reducing positions. So I think there is quite a bit of pain out there. To go to your point is that can the underlying bull market continue? It sounds trite, but it is all about the Strait of Hormuz and when that kind of opens. The underlying fundamentals going into March elsewhere were extraordinarily positive for global stock markets. But this conflict is a real development, and people don't seem to be fully factoring that in yet.
You talk about how stock markets are crashing globally, minus the US, but some of these stocks market, like Japan, like Korea, come from a very, very elevated level. We've seen massive gains before this crash.
Yeah, they do. You're right. I mean, I think that context is very important. And again, it goes back to the fact that, 6-8 weeks ago, it doesn't really matter, before the conflict, we probably had the most bullish macro environment for global stocks that I remember ever seeing. And the reason that is that we have fiscal expansion almost every part of the major economy in the world, from the US, from Europe, from China, from Japan. You've also got an extraordinary private sector fiscal expansion because of the capex bubble, which is still in the inflation stage. So you've got private sector and public sector just pouring money into an economy where growth is already okay. And then rather than applying the brakes and worrying about inflation, the Fed is getting under pressure to have easy monetary policy. So this is just an incredibly constructive environment for stock markets. So it made sense that stock markets were doing so well into that, and they were doing very, very well. But the conflict's still a real development. And I think that, the longer it continues, they still have a long way to go because they had risen so much. And this is suddenly going to cut off not just energy supply, but it's a supply disruption much more broadly on a lot of like oil products and other products as well, like fertilizer, helium. People are starting to talk about the kind of knock-on effects. This is an important supply disruption around the world, and particularly for Asian economies.
Perhaps the real reversal will come when central banks start pivoting, tightening. We saw RBA and other central banks may do the same. That may perhaps change the sentiment in the market.
That is one of the narratives out there, that the pain kind of transmission comes through the rates channel. So it comes through central banks getting more hawkish, which is probably too early for them to do this week. Because if this all resolves soon, central banks want to look through this temporary shock in oil. So we're maybe not going to get that shock soon, which is why some people are kind of going, hey, it's okay in stocks, until we know yields are going to rise. I think that the people are discounting that we get a real demand destruction impact from this as well, because that impact is slowly growing as well. Either way, for you to be optimistic, I'm not saying you should be proactively bearish on stocks here, unless you have very strong views on what the conflict is. But you can't be optimistic on stocks right now unless you have strong visibility on when the Strait's going to having decent amount of traffic again. And unfortunately, I don't see that at all, which is why I think it's very asymmetric. I think the gains will just keep on slowly getting bigger and bigger. And that's why the worst month for global stocks in 3.5 years, I think it can get worse from here.
I think the question really as well is whether or not the markets in the U.S. can remain resilient, because you talk about how people are looking through the stock market through the prism of the U.S. market. Can the U.S. remain resilient from here?
Relatively, yes, but relative is the key word there. I mean, U.S. is an energy exporter. I think, many of the...
Costs still get translated to the consumers.
Absolutely. So that's what I'm saying. It's a relative basis. I think I am on the more bearish end of the spectrum. The reason I phrase it like that is because no one can have high conviction on what's going to happen on the Strait and on the conflict. It doesn't seem like the US administration knows what the plan is, which is why none of us can really know, which is why I kind of would challenge anyone who's got super high conviction. But I am very much on the bearish end of the spectrum, that I think, because I see no visibility, I think the asymmetric skew is for stocks to fall significantly further. And I think that will drag down US stocks as well, because I think there will be that demand destruction. I think there will be the inflationary impulse. The cost will pass on to the US, exactly as you say. But on a relative basis, the US stocks will outperform for as long as the conflict extends. I then think we go back into the multi-year theme of US stocks underperformance, which started just over a year ago.
Mark, thank you. I'm Life Executive Editor Mark Cudmore there. Let's get perspective from Lorraine Tan, Director of Asia Equity Research at Morningstar. Lorraine, good to have you with us. What do you make of that risk appetite, and what do you make of the sentiment in the market right now?
Yeah, I think, in reality, we've been lulled into a sense that these things are short-lived, because based on past experiences. And so therefore, even with the Ukraine war, the breaking out of that breakout, the prior skirmishes, stock markets never really fell particularly a lot, and they had recovered very quickly. So I think investors are still of the sense that this is a short-lived thing, and that therefore markets will rebound. And I think that's why it's been hard to buy on this event, because stocks really didn't fall enough for the most part for us to be buyers. And I do agree that at the end of the day, the risks are there. Yeah.
But some markets have fallen in a big way. Mark talked earlier about how some of the markets have crashed. Japan down almost 8%, Korea down about 10%, France about 7%, Indonesia 14% so far. Yeah. If you take a longer term perspective, why wouldn't you be buying into some of these markets?
Okay, so I think some of the markets that you mentioned, particularly I would say Japan has had a very solid run-up the year to date prior to the event. Obviously, excitement over the Takaichi policies came through. So I think in Korea, obviously, these markets had gone up a fair bit. So I would say that the pullback that you're seeing, 7% for Japan in particular, probably still hovers around fair value for us. Certain sectors obviously are cheaper than others. For example, the consumer sectors have been underperforming for quite some time in Asia and continue to do so. And that's probably where there's a bit more value. Technology was the one that, if you look at Japan, had really risen a fair bit. We'd like to see a little bit more of a pullback in some areas, and there are some opportunities, not so much because of the Iran war, but because of SaaSpocalypse sending some of the prices of quality names down. Probably a little bit more, probably slightly indiscriminately in terms of that sell-off.
Talking about the sell-off in this part of the world, apart from Japan, is also Korea, down about 10%. Are valuations still looking expensive, despite that sell-off that we saw recently?
I'd say that most Asian markets are what we would term to be fairly valued to our long-term valuation, our intrinsic value of the companies that we look at. So it's not to say that there aren't buying opportunities. It's just that we're probably going to be much more selective in that sense to find where the value is. I think one of the issues for Japan, definitely costs will rise for the most of Asia, to be honest. Yes, there are strategic reserves available, but things like naphtha are imported. So we do see petchem product prices actually pushing up inflation for the most part. So that's one of the things that keeps us a little bit conservative. Consumers will probably start to adjust their spending a little bit. And so that's going to slow. I think there are macro concerns that will come through the second quarter of this year. And so we'll probably have to watch out a little bit for that.
You talked about how the selling from Sascapolypse is pretty much overdone. What opportunities are there on the back of that?
Well, what we did at Morningstar was basically review a lot of the moat ratings for the companies that were impacted and sold off more heavily. So a lot of, obviously, software names, et cetera. Within Asia, we looked at about 18 names and downgraded the moat ratings in about half of those. But there are companies, for example, like a Nintendo gaming company that had been weak on a relative basis this year. We think that's a buying opportunity. There were concerns on Tencent, for example, lagging in terms of the AI push. We do like Tencent as well. And there are a couple other companies that were sold down, like a gaming company like Nexon. Some of that is because the performance or earnings were a little bit of a concern, but we do think that these are short-term factors, and the underlying economic moats for these companies are still very solid.
What kind of upside do you see in some of these companies, Lorraine?
Well, for example, if I were to look at Nintendo or Tencent, both were looking at around I think about close to 20% upside to our intrinsic values, at least, and in the case of Tencent, maybe a little bit more. Obviously, Tencent's results are coming out soon, but we do see these things on let's say, a 5-year basis. And the companies with their own IP, such as Nintendo, such as Tencent, I think will still remain very competitive. They obviously will benefit from AI as well in terms of the reduction in programming costs or coding costs, and that's going to improve their productivity and their efficiencies, and that's going to filter through to their own competitiveness as well.
And of course, the AI theme remains pretty much intact. The likes of Samsung, HK Hynix in Korea. What's your own assessment about whether or not they continue to be a buy?
We actually are the outlier there. We are probably one of the few sell calls, and that's because we look beyond 2027 in our earnings, and we expect the cycle for memory prices to come off thereafter because capacity is coming through. So because of that, we would not be buyers of Samsung or SK Hynix yet at these current levels, even though they have pulled back a bit. We're still seeing them to be 25 to 30% above where we want their share prices to be.
And of course, the two companies account for about 40% of the weighting in Korea. Does that shape the way you look at Korean stocks in any way?
It does. It changes the way we may look at the Korean market as a whole. If you play the Korean index, obviously you're going to be very, very exposed to what these two companies do. So it has tended. The swings will be based on where where you expect SK hynix and Samsung to be. So because we're still bearish on those, in sense we have sell calls on both companies. Therefore, we also see the Korean market as being relatively expensive.
Lorraine, I see that you've also downgraded some companies, the likes of Baidu, Naver, also Dentsu and Nomura Research Institute. What's behind that call?
Mainly because we see the risk of the AI developments eating into their competitiveness. So, for example, if I were to take some of the search engines like Naver and Baidu, for example, we don't have a lot of clarity on where their how stable their earnings stream and their returns are going to be in terms, because for example, ad placements, people bypassing search engines to get information. Probably that's going to happen with AI tools that are coming out. So we're a little bit more concerned probably about where these companies are headed in terms of their economic profit. They'll remain profitable. The cash flow will still be decent. It's just not at the level that we want it to be in, let's say, in 5 years' time, relative to their cost of capital.
When it comes to AI, would China plays be a better bet right now?
I would say that in terms of relative valuation, also in terms of, believe it or not, somewhat of a more resilient energy security situation, definitely China has stocks that we are more keen on right now on those few factors.
Lorraine, hang tight. Lorraine Tan is staying with us. Up next, what to expect from Tencent's earnings out later, with the company's agentic AI ambitions a firm focus for investors. Keep it here with us. This is Bloomberg. Welcome back. You're watching Inside. Chinese tech stocks are underperforming in Asia today. The spotlight is shifting to Tencent's earnings out later after its music arm showed growth slowing. Avril is back with more. Avril.
Yeah, Has. After the Tencent music earnings, of course, the focus is squarely on Tencent, and it's set to clock a fifth straight quarter of double-digit revenue growth thanks to its core businesses of ad and gaming. But aside from some of these numbers that we are expected to see flip the board as well, because I think investor focus is also going to be on some of these AI agentic ambitions. It's expected to go head-to-head with Alibaba as well, and it's well placed to do so. I mean, Lorraine was just talking about its moat, right, and its edge in the previous segment, but it's interesting. Tencent also has other things going for it, including its user data treasure trove and the WeChat ecosystem. And you think about as well in the past week how it's been rolling out these products to capitalize on the agentic AI craze in China. Now, flip the board again as we mull the competition between the big Chinese tech giants Alibaba and Tencent. It's also worth noting that for Chinese shares, they have been bottoming out against the region's benchmark, which is interesting to see, as we were discussing earlier, right? How Chinese shares have been seen as a bit of a haven amid the Iran war. What's changed also in the past 2 weeks is now it has better inflation data out of China and retail sales going for it. So some things to keep in mind even as we look to Tencent earnings coming up.
Avril, thank you. Lorraine Tan is still with us, Morningstar's Director of Asia Equity Research. Lorraine, of course, we heard, and we've talked about how Tencent's out with numbers. It's about AI, agentic AI. What in particular are you looking out for?
I think for Tencent, it's pretty much business as usual for its gaming side, its WeChat functions, etc. I think the company is well positioned in terms of to benefit and to monetize from a very strong network effect that it's built up over the years. And so we actually see the platform as being a strong point for it to defend in terms of, at the end of the day, AI tools may be there, but they're still going to have to be utilized as part of the WeChat platform. So I think it actually points to benefits that Tencent could have. And I think for the analysts, it's just trying to understand what the plans are on the AI front. And I think at the end of the day, that's going to be part of it. That's going to and how much growth that can generate as well.
And speaking of growth, Tencent and, in fact, Alibaba, both companies are trying to capitalize on the open claw hype. How much growth do you think they can get from that?
It's hard to say right now because, if you look at Alibaba, for example, some of the AI business in general that it has, it's not quite profitable yet, given the amount of investment that's pouring in. And I think that's the key question for a lot of companies that are investing in AI, in cloud services, etc. So when do these things start to generate profit? At this point in time, we expect that to happen over the next few years, but I can't really begin to sort of estimate what it would be immediately right now.
And Lorraine, we have the earnings from Geely. Geely earnings just out as we spoke. Geely Auto financial year net income coming in at 16.85 billion yuan. The estimate was for 16.51 billion yuan. So it is better than anticipated. And it also sees 2026 capex about 16 billion yuan. Your take on the numbers we're seeing so far, Lorraine?
I think for the China auto side, it's been very much about the competition, right? It's particularly on the EV front. All vehicles, the ICE section have been losing market share anyway to EVs, and there's been immense competition. What's been interesting is that, obviously, propping things up is that the volume sales for EVs has actually improved a fair bit, and I think Geely benefits from that. It is one of the more successful companies that's managed to bridge from ICE into the EV space. It's got a nice portfolio of brands, Zeekr, Polestar, etc. And I think so it's been able to do that. And therefore, we actually have that as one of our preferred stock picks, Geely. And at the end of the day, as the volume of sales continues to increase, ultimately we expect margins to start to recover for the EV space. And that's what we're looking out for over the next few years.
And of course, China's expanded funding from vehicle trade-in program, Geely among those that will benefit from it, isn't it?
Yes and no. I mean, it comes from a very, very high base last year, so we do actually expect a weaker first half sales in that sense for some of the companies. So we actually think that a lot of the EV stocks are a little bit overvalued at this stage, given the first half of this year may be a little bit underwhelming in terms of year-on-year performance. But at the end of the day, when we look beyond this, definitely we see more value in Geely relative to some of the other names like BYD or NIO right now.
How about XPeng?
XPeng, obviously, the joint venture is, with Volkswagen helps in terms of, and I think these are all volume gains that will help drive operating leverage for the companies. It's just that I think a lot of share prices had actually, for the EV space, actually moved up beginning of the year, end of last year. So it's just that, just purely based on valuation, it's just still we're going back to Geely as our preferred stock pick.
I want to go back to the Chinese market as a whole, tech in particular. It does seem like Chinese tech is pretty insulated from the Iran war and therefore a good play. What are your thoughts on perhaps the winners and the losers in the space in China?
I think it boils down to valuations. We had a huge run-up in some of the chip names. I mean, we still think that a lot of the semiconductor names in China are overvalued. We have much greater preference for names sort of that have lagged, like your Tencent or Alibaba. We still like these names because we still see very strong, positive competitive advantages because of the as I mentioned, the networks that they've been able to build up through their businesses as it is. So monetizing opportunities are there for these companies. As you mentioned, consumer data has probably bottomed out for China, and we think that ultimately is positive, but the growth in itself will still be slow. But in that sense, we anticipate a little bit of a better uptake for some of the consumer names as well.
Lorraine, thank you. Lorraine Tan, Director of Asia Equity Research at Morningstar. Still to come, as Iran confirms the death of security chief Ali Larijani. We'll look at what his death could mean for the war's timeline. This is Bloomberg.
So I think NATO's making a very foolish mistake. And I've long said that, I wonder whether or not NATO would ever be there for us. So this was a great test because we don't need them, but they should have been there. The other thing is, and I think, very important, we didn't have to be there for Ukraine.
We are not a party to the conflict, so France will never participate in operations to free or reopen the Strait of Hormuz in the current context. However, once the situation gets calmer, and intentionally, this term is broad enough, meaning once the core of the bombing has ceased, then we are ready with other nations to take on other responsibilities, such as an escort system.
We obviously have to take everything that the President of the United States says seriously. Those countries that have the capacity and the will to help the United States will do that and should do that.
President Trump and some NATO allies there as global leaders show little sign they're planning to join the conflict against Iran. Meanwhile, President Trump has confirmed he will postpone his upcoming planned trip to China, but no future date has yet been set. For the latest, let's bring in our Chief North Asia correspondent, Stephen Angle. And Steve, what is our best estimate of when the summit will actually happen? I mean, some reports suggesting a month from now. Does this potentially derail progress on trade talks?
Well, yeah, we'll take this in two different chunks. When is it going to happen? Well, Donald Trump said maybe 5 to 6 weeks delay. So we're looking at either before the May Day holiday or afterwards. So at the end of April or possibly mid-May or even later, because their justification right now for this delay, as we've heard over the weekend as well as the last couple of days, is the logistics. And also, look, the White House has its hands full with Iran, obviously, as it goes into the 19th day of strikes. So we don't know how long that will last, obviously, the hostilities. So I guess it's a fair assumption to say that this summit, which was due to begin in about 2 weeks' time in Beijing, will be delayed until the hostilities in Iran are lessened. Let's just say that. I won't say necessarily over. And again, I think it gives Beijing as well a bit of reprieve because sources have told us behind the scenes that Beijing did not necessarily want to see this go forward at this time, this summit, because they do not want to be perceived as endorsing the White House's or Washington's war in Iran. So it's face-saving, I guess you could say, for both parties, and then they can get to the meat of what they want to talk about, and that is more solidifying their lasting peace. They've already been talking about having this new mechanism for bilateral trade and bilateral relations following that weekend meeting between Jamieson Greer, the U.S. Trade Representative, the Treasury Secretary Scott Bessent, and their counterpart there from the Chinese, He Lifeng.
Of course, we heard from Wang Yi. He touted the year to be a big year for U.S.-China relations.
Yes.
Will this delay in any way reset, how the two sides look at each other?
Well, you would assume it will, obviously, because Beijing, for one, has been fairly quiet on the war in Iran. We all know that Beijing and Tehran had strong relations, do have strong relations. China has vast interests across the Middle East, including buying a lot of that Iranian oil. So you have to wonder how this changes the calibration of how Beijing sees Donald Trump, given the fact that you just ran through that list of NATO allies and other allies of America not willing to come to the aid of Washington in the Strait of Hormuz. It is something that Donald Trump had asked Beijing to do as well, given their big commitments to purchase oil from the Middle East and how many Chinese tankers do go through the Strait of Hormuz. China has not answered that request. And just on the weekend, in an interview, Donald Trump basically said, we will delay this trip if Beijing does not come to the aid of ships passing through the Strait of Hormuz. Of course, the administration, Haslinda, has backed away from that narrative. In fact, Scott Bessent has said that's a false narrative. We are not connecting the delayed trip to that request that Donald Trump had made over the weekend. Now they're simply saying it's because the war is preoccupying all their attention and the logistics would be quite tough. You mentioned the trade deal. Jameson Greer, he said the delay of the summit has no relation to the trade and economic talks with China at all. Again, we'll have to take them for their word for right now.
Right. And to that end, economic relations, at least within the two sides, have been pretty stable. Is there anything that could disrupt that?
Many things could disrupt that. The export licenses for rare earths, if that gets bogged down, if commitments to buy soybeans gets bogged down, if geopolitics and the concerns about the war in the Middle East bog down the relationship, there's so many wild cards in this. And that's why I think both sides had agreed before what transpired 19 days ago in the Middle East, wanted to get this meeting done. They want to meet face to face to help bring stability. Xi Jinping, you see there across the table from Donald Trump, and the leadership in Beijing absolutely wants and desires stability in their relationship with the United States. It was a hard-fought truce, if you will, by both sides that was secured in December, but it's a tenuous truce. So absolutely. I'm not saying that what's transpired in the last 24 hours with the delay or postponement of the summit will derail their economic progress, but it doesn't help. Or it does give them time to get their ducks in a row.
Right. I'm curious because both sides want to reset bilateral relations. How might that look like eventually?
That's another wild-ended question because they're coming from quite a nadir, especially after Liberation Day and the assault of tariffs on the global, trading system by the Donald Trump administration. So they brought it up to a level, and then the Supreme Court of the United States obviously helped out, many say, China's case against that unilateral approach to trade by the Trump administration. But we got up to that agreed upon equilibrium, if you will, in December. And that is something both sides would want to continue to build upon instead of going back to threats of 145% tariffs from the Trump administration and reciprocal tariff threats by the Chinese. So it's really hard to say where these relations go without all these geopolitical and economic shocks that keep on popping up and kind of putting bumps in the road.
Great insights. Our Chief North Asia correspondent Stephen Angle, thank you so much for that. Meanwhile, Japanese Prime Minister Sanae Takaichi faces a diplomatic balancing act at a summit this week with Donald Trump. This after the U.S. president called on Japan to deploy warships to help secure the war-stricken Strait of Hormuz before abruptly dropping that demand. Laura Davison, who is our Washington Deputy Bureau Chief, joins us live from Tokyo. And Laura, how does Takaichi handle this delicate moment?
This is a really tricky situation for her. She'll be headed to the White House. This is her first trip to the United States since entering office. Really, her first stop at the White House is that she will go into the Oval Office with Trump in one of those scenes that we've seen many times before with foreign leaders. She'll be sitting on a couch, so Trump will be nearby. Some other U.S. officials will be there, and then the press will be crammed in. And this conversation can go anywhere. We've seen for some leaders, New York City, Zohran Mamdani, the mayor there, had sort of the best scenario where it was a very warm and cordial relationship. The most famous example of this going sideways is with Vladimir Zelensky, and really this almost evolving into a shouting match. Almost anything is possible. So Takaichi's going to have to go in with she has a warm relationship, being able to convey that warm relationship, but also she has an agenda, and she has to and has said she's going to push back on the Iranian war. Said she wants to talk to Trump about that, and say, look, that. The approach she doesn't agree with. She's questioned whether this war is legal. She has been quite silent on the fact of these warships and really shied away from that question. So there's a lot of complications for her and a lot that can go wrong if suddenly the mood of this meeting gets off balance.
I guess it is a balancing act for her, for Takaichi. What does she hope to achieve during that visit?
Yeah, so she has a long list of agenda items she wants to achieve, largely looking at some of these business investments. This is a fund that was set up as part of this trade arrangement. So, making sure that trade arrangement is strong, those lower tariffs are secured going forward, and that this fund gets off the ground. This is one of the things that has made Trump happy about this trade deal. So that's sort of the linchpin there for her to make sure that those business deals are getting off the ground. Those are things involving energy, liquefied natural gas, rare earths. There was a whole summit in Tokyo over the weekend where U.S. officials, Doug Burgum, Lee Zeldin, were discussing some of these deals as sort of a precursor to this meeting here in Washington this week. The other thing, too, of course, that she's very focused on are looking at things like energy security. One thing Trump wants from the Japanese is for them to buy more U.S. oil. That will certainly be on the table, as well as deliver a message. One of the reasons of the timing of this meeting is she wanted to meet with him before Trump went to China to meet with Xi. Tensions between China and Japan are at an all-time high. What those military alliances look like, what security in the region looks like, are very important to her. And now it looks like she'll have this meeting will have even more importance with the Xi summit being put off until the indefinite future.
Laura, we've been reporting that U.S. allies have pretty much snubbed Trump on his requests for, provide protection on the Strait of Hormuz. How does Trump now approach U.S. allies now that they've rebuffed him on the warships?
Yeah, this is sort of a tricky moment for Trump. If he has been out there, really for the 3 weeks almost since this war began, asking for support, asking for help, and sort of at every corner, allies have said, look, we weren't consulted on this war. This isn't our war to fight. And we're certainly not going to put our troops or our machinery, our equipment in harm's way when we don't even know what the objectives are of this war, how long this will last, what the cost could be. So this is, kind of a different moment from really what we saw even just a year ago at the beginning of Trump's second term, where foreign leaders were almost falling over themselves to make sure that they were appealing to Trump, that they were appeasing him, that they were giving him what they wanted so they wouldn't get hit with tariffs. Now, Trump has lost a lot of his tariff weapon, not entirely, but at least the way he could just implement tariffs with a tweet has gone by the wayside. And you see allies sort of pushing back more as a group, saying, look, we're going to do what's in the best interest of our country. This puts Trump in a difficult position because he doesn't have quite the same sway. A lot of foreign allies are also realizing that he's only in office for less than 3 years going forward. So there's sort of a balancing act there of, doing enough to make sure that they don't get in Trump's crosshairs and become, sort of a public enemy that he is lambasting on social media, but also recognizing that they don't need to necessarily take big, drastic steps to appease him.
Well, the thing is, Trump is a president who doesn't really take no for an answer. He takes it personally as well. What might be the repercussions from those allies saying no to him?
This is, this is the risk here. We saw, Trump has specifically called out Keir Starmer this week, saying that the U.S. will remember that, that the U.K. didn't rush to the U.S.'s defenses in this war. He's also called out China in particular. This is kind of one of the issues that we've seen play out of, that leaders want to make sure that they're not sort of at the number one on his hit list and the people that he's most angry about, but also and sort of trying to sort of quietly, keep him happy. But while not necessarily needing to do things that are outside of their interests, this is a huge risk. There are whole, in fact, lobbying shops in Washington working both with CEOs as well as foreign governments who find themselves in this precarious position.
Is there clarity on why the U.S. allies said no in the first place? Is it the risk of providing the protection on the Strait of Hormuz? Or is this a case of saying, we weren't consulted before you made the move with Israel?
This is really sort of a twofold of one, they weren't consulted. They don't see the reasons why this war needed to happen right now and sort of what the long-term commitment, could look like in this war. The second is the specific ask here on sending warships to the Strait of Hormuz is logistically a very difficult, complicated, costly, and potentially costly in terms of human lives endeavor that they'd be looking at. And that was a particularly difficult ask. We have seen, some countries provide support in smaller ways. Of course, all of the allies in the Gulf regions have U.S. military bases in there and have been working with the Americans on defense there. We see even Ukraine provided some missile drones and some technology that they've been testing out. But sort of in terms of sending manned ships into the region, sort of the one of the most the hottest spots for this war was just a no-go for a lot of countries. It was just too big an ask.
Laura, thank you. Laura Davison, Washington Deputy Bureau Chief for us there. Now, the world's biggest miner has named its next CEO. BHP's tapping Brendan Cragg to tackle a Middle East war, a cooling Chinese economy, and a shift towards copper. More on his challenges next. This is Bloomberg. Welcome back. You're watching Inside. Just some lines to tell you about from the Prime Minister of Japan, Takaichi. She says that it will be a very challenging visit to the U.S., but she will do her best to protect Japan's national interests. Of course, Sanae Takaichi faces a balancing act at a summit this week with Donald Trump. This will be her first visit to Washington. That's happening on Thursday since winning a sweeping mandate, which has been widely viewed by Tokyo as an opportunity to showcase the strength of the U.S.-Japan alliance despite challenges of a trade, perhaps more importantly, seen as a chance to gain the presidency before his meeting with Chinese leader Xi Jinping. As we know, that has been delayed. Again, the Prime Minister of Japan saying that it will be a very challenging visit to the U.S. when she makes that visit on Thursday to meet Trump in a summit, but she will do her best to protect Japan's national interests. Meantime, IBM CEO Arvind Krishna says the company is eyeing more AI deals as it sees lighter regulatory pushback. He shared details of IBM's M&A strategy following the company's $11 billion acquisition of data streaming platform Confluent.
I think the regulatory environment is definitely friendlier, where we got this done in just under 4 months, whereas it used to take a lot longer a few years back.
If regulatory environment is friendlier, should you be doing more of it? Should there be more M&A, particularly with some beaten up overall valuations of software companies at the moment?
I'll just say watch the space.
Oh, watch the space. Okay, but where would you want to add on in this moment? I mean, what would make sense to be adding to your portfolio?
So we're very focused. Hybrid cloud and AI and the intersection. The work we're doing together with Nvidia was a 5 times speed up. So 5 times, not 5%, not a little amount, but 5 times. So there we began to leverage the Nvidia GPUs together with some of their CUDF or software, combining it with our Watson X data. And the example we used was our client Nestle, where together we managed to get that speed up across their massive amounts of data, and that really is important. In that case, combining some of the technologies we work on also in open source with the Presto data engine, Nvidia, and the example at Nestle, but then we're very excited. We're going to do more work on that and then take it into the market and take it out to hundreds of clients from there.
That was IBM CEO Arvind Krishna speaking with Bloomberg's Caroline Hyde. Now, in other corporate news, BHP named Brendan Cragg as its next CEO. The company says Cragg will take over from Mike Henry from July 1st. For more, let's bring in our metals and mining reporter, Paul Allen Hunt in Melbourne. Paul, what can you tell us about BHP's new CEO? We know that he is a veteran of 25 years.
That's right. He's been around BHP for a very long time. He has worked across its copper assets. Most recently, he was the president of the Americas region, which is really the engine room of growth for BHP. Prior to that, he was also the head of iron ore, which is, of course, the real commodity that has turned BHP into what it is today. And prior to that, even coal. So this is a man who's been with BHP, like you said, for 25 years. He's got experience in a variety of different roles. Now he replaces Mike Henry. He is well known for being an operator. He's an engineer by training. It's a remarkable turn of events. Obviously, we started reporting on the succession planning some time ago. Today, they finally made the announcement that Brendan Cragg, 53 years old, is now the CEO of the world's biggest miner.
What is Brendan Cragg really inheriting? We know there are lots of challenges, including a weakening Chinese economy.
That's right. So there is a softening demand in China for iron ore. I think most analysts agree that there is plateauing demand for iron ore from China. BHP, generally speaking, it's got a lot of optionality in front of it in copper. That's where Mike Henry, the outgoing CEO, really put a lot of effort into ensuring that there was a lot of portfolio opportunities to develop new mines. It's returned back to mergers and acquisitions under Mike Henry, and it will be interesting to see whether Brendan Cragg is also looking at M&A deals and that sort of stuff, although he did say today in a press conference that any deals would have to be very value accretive to BHP. They're not just going to go out and do deal making willy-nilly. So BHP is relatively speaking in a very good position. However, it does have its challenges. Its coal portfolio in Australia is not making any money. It's still negotiating with the top China buyer of iron ore over a pricing dispute that's been running for several months now. And it's got a long way to go in terms of building new copper assets in Chile and in Argentina.
As you said, China is key, so is the Americas. I mean, what plans might he have for that region, which is crucial for the future of BHP?
It's been really interesting looking at BHP's geographic mix over the last, 10 years to what it is today. From a company that was so very Australia-focused on iron ore to one that has really spread its wings. It does have assets in Chile. It's really investing a lot of money to ensure that those Chilean copper assets, copper, which it sees as such an important growth commodity, it's investing a lot of money in Chile. It's also expanding into potash. That's the next big thing for BHP. That's a commodity used in fertilizers. They're about to bring on their new potash mine, Jansen, in Canada. And of course, like you said, its iron ore business is still there, but and very important. But copper is now becoming even more important to that company.
To your point, though, iron ore is a pain point for the new CEO. Why is that, Paul Allen?
I think while it has always generated, the bulk of BHP's earnings, this was the first year or the last 6 months, copper actually rivaled that. I wouldn't say it's necessarily a pain point for the new CEO, but there is a lot of work that's going to have to happen in terms of those negotiations with the CMRG, which is China's biggest buyer of iron ore. So that's been set up over recent years by China to have more of an influence in the market, to help it achieve better pricing. BHP hasn't managed to resolve those negotiations in terms of price disputes yet.
Right.
So we will wait and see what he does there. He did say today that management would fly to China very soon.
We have to leave it there. Paul Alan in Melbourne, thank you so much for that. Here's a look at our guest for tomorrow. Christopher Wilcox will be joining us. This is Bloomberg.